Hi, I'm Art Bergeron, and welcome to this Bergeron Briefs episode. Today, we are talking with my friend Scott Auen from Cornerstone Bank about an issue or a solution to an issue that comes up with my elder law clients all the time. As folks know, I always talk about my friends Frank and Mary and their kids Peter, Paul, and Mary Jr. The joke is if you can get the joke, you're old enough to be my client. And their goal, which is to live in their house until they die and be buried in the backyard, and ideally leave as much as they can to their kids, not to the nursing home, not to the government, to their kids. But what often comes up for my folks, is you get older and you got a house and you kill yourself to pay off the mortgage, right? Or maybe there's a small mortgage left. But you don't have a lot of money. You're on a fixed income. Now you're getting Social Security and pension. You got a little bit of cash, but you got a house. And your goal is to stay in your house forever, but it's a house, and houses are expensive. Stuff happens with a house. It's not $5, it's 1,000 here, it's 10,000 there. And so you're trying to figure out that, and you're also trying to figure out, as you get older, you never want to go to a nursing home, which means you want to stay in that home. And it may be that there are some home things that you need to do to make that home safer for you, right? So they tell my clients, you can live in your home for a long time and just don't fall down. Do not fall down, right? Or you may just need some help. You may just need some personal help, and you don't have the kind of savings, to deal with that personal help. So in all of those issues, I often tell people, I know you saved forever and you really want to leave the house to the kids, but you want to stay in your house until you die. So how do you do that? And so I asked Scott to come on and talk about those issues. So Scott, can you just tell us a little bit about you and Cornerstone Bank and how the two of you ended up being connected? And
Sure.
let's talk a little bit about those issues. Okay.
Yeah. So again, like Arthur said, my name is Scott Auen. I'm the Executive Vice President of Retail Lending at Cornerstone Bank. I've been with the bank for a little over 11 years. Cornerstone Bank was derived from a merger between Spencer Bank and Southbridge Savings Bank. I've been in the financial services industry for over 30 years. I worked for larger institutions, small institutions in the Midwest, on the East Coast. So I have a broad range of experience and exposure to all types of financial issues. What you're talking about with the home equity, it's a big product right now for us. And we've seen a very big uptick in home equity lending really is around 2021 because interest rates dropped. Homes appreciated, through the roof. So there's this wealth of available funds in equity. And, speaking to, your type of clients, qualifying for that and be able to getting that, it can definitely get done and it's easy to do, but there are a little bit of nuances to it, which we can talk about today, Arthur.
And that's what I'd like to do. So, think about, so I'm Frank and Mary, and I'm trying to weigh my options. And in that situation, I have the house, I have a little bit of extra cash, but what I really want in this case, which I hope I try to make the typical case, it's not an emergency yet. It's not an emergency yet. I don't need a check for $100,000 tomorrow, but I want to sleep well at night. I tell my clients, you get to our age, and fame and fortune has passed us by. You just want to get a good night's sleep, right? So I want to, and it's going to help me sleep knowing that because I think about these possibilities. What if the roof goes on the house, and what if I need a septic system, or what if I am personally more disabled and therefore either need to change the house to add things, to add whether it is something to get me to the second floor or lights or whatever. Or I need some care at home. How can I sleep better at night?
Yeah, and that's with obtaining a home equity line of credit. And ideally, they should be thinking about this before they retire. During their years of higher income, it'll be much easier for them to qualify. But let's say they've already retired and they're on that fixed income, whether it's pension, Social Security, we can still qualify them, but we have to qualify them off of that new income stream. So it can still get done, but we have to look at really their ability to pay it back. But the beauty of those emergencies and sleeping well at night is having that home equity line of credit in place, because you only will have to pay it back when you utilize it. So it's that flexibility and be able to access those emergency funds when you need it is really the main driver why you should have a home equity in retirement.
So can you talk to me or talk to us? It is now, it's August of 2023 and the rates have gone up, and so can you just talk a little bit about if a person came in, say they've got their house and it's worth $500,000, not an unusual house anymore, right? $500,000, no mortgage. There's Frank and Mary. They've got their, and he's getting Social Security of a couple thousand. She's getting half of his, so she's getting $1,000. So they get an income of about $3,000 a month. And once again, what I'm telling you, you've heard a jillion times, in these kind of variations, right? Can you just kind of walk Frank and Mary through what the process would be that the bank would use if they came in to kind of analyze what might be available to them, and then if they wanted to go through with this and use what I always remember, these used to be called home improvement loans or whatever, and I keep thinking of home equity lines of credit or HELOCs, right? But if they want to be accessing that, what are they going to need to go through to do that? How are we going to figure out how much they could afford to get as a line of credit? I always tell people that this is a credit card that's supported by a mortgage,
Correct.
So how big a credit card, and you got a credit card limit, it's a credit card, right? So how much credit can you get, and what are you going to have to go through in order to get it in terms of upfront costs and closing costs and any of this jazz? And then down the line, how's that going to work?
Sure.
How long does the line of credit run for? When if ever does this have to get paid off? Because often people are comparing this to like a reverse mortgage. So you're saying, where am I going? So, and I know you're shaking your head, but that's why I want you to understand why they should be coming to that conclusion.
Sure, they would simply, come into one of our local branches. We would sit down with them, take maybe 15, 20 minutes, fill out a simple application. Then getting into the qualification process, it's really looking at their credit, which we're assuming is typically always very, very good. How much equity, they have a ton of equity. And then we'll look at what their income is, pay stubs, Social Security, pension, have they been taking any draws out of their investment accounts? And then based on all those characteristics, we would determine how much they would be eligible for. And the mechanics of the HELOC is there's a draw period and a repayment period. And the draw period is typically around 10 years where they can access those funds and draw it down. And typically most lenders, there is no fee if you don't utilize it. All lenders are different. And that payment is typically an interest-only payment, which is tied to prime. And granted, prime has gone up, but again, you're only going to pay, and it's only interest-only payments during the draw period.
And it's only interest-only payments on the money that you've used, not the entire amount of the line of credit, right?
Exactly, only amount you use. So you really want to think about, it's not to be used as an income stream. It's really for, home improvements, emergencies, things like that, or you want to help your kids out with a down payment or something major or significant. And typically there's a margin tied to it, whether it's prime plus or prime minus, prime minus a half. Every lender's different. And there's typically a floor rate, which is around 3 or 4%.
And once again, if I were walking in today, and once again, this is August of 2023. If I were walking in today, about what would that rate look like?
Well, for us, we're prime minus a half, so that would be 8%.
I get it.
Yes, prime is 8.5. But we also have a feature where once you open the home equity line of credit, you can take a fixed rate advance and lock that in for a period of time, whether it's 5, 10, or 15 years, but you're starting to pay that back in an amortizing payment. But the advantage of that is it's a fixed payment and a lower interest rate.
I see. So these, when I think about HELOC, I'm thinking about something that's more kind of cut and dry, but you're telling me that at Cornerstone, because you're doing a lot of this stuff, you're also looking at different variations on that theme, really in order to accommodate what the customer is looking for, right?
Exactly. And then you get into the repayment period. That's typically a little bit longer than the draw period. Yeah. But at that point in time, you can no longer draw on the funds. The repayment period runs from anywhere from 10, 15. I've seen some as far as 20. And that payment is really an amortizing payment. So you're starting to pay back principal and interest. And this is a good point to remember for, Frank and Mary. that payment should be or will be significantly higher than the interest-only payment, right? Of course, because now you're paying back principal. So during that qualification process up front, we try to qualify them to avoid what we call payment shock, right? We don't want to be shocked by a large payment if you have to pay all that back over the repayment period. So that's why we want to put them in, the right credit limit, knowing they have the ability to pay it back.
And when you're doing that kind of qualification, is your analysis of ability to repay based on the ability to repay the interest only, or on the ability to pay if they start at that point where they're actually having to repay the principal?
Yeah, we look at it as far as if they drew the entire credit limit out.
Yeah.
And that payment during the repayment period. So we are qualifying that much higher than the interest only payment. And most lenders do that, and they should do that, right? Because you don't want to put them in a situation, we want to make sure.
And I guess from Frank and Mary's perspective, therefore, right? If they were doing this, they might really want to be looking at, once again, how old they are when they do this, because you're telling me that in the typical package, you've got interest only for 10 years, and then that other thing kicks in, and you're saying to yourself, well, I don't want this other thing to be kicking in, and I'm like 90 years old, and I've got and now I'm really, because the older you get, the more you're kind of stressed in terms of these finances, right? But I suppose that makes sense to look at that up front, right? So
it does, and you are accumulating debt, and like you said, it is basically simplistically a credit card tied to your home,
right?
And you want to make sure you use it wisely, and it's a better tool than, say, pulling down funds from your investment accounts, right? Especially in a down market, you're losing wealth accumulation by pulling those funds out,
right?
And it's better off utilizing that HELOC, and then when the market turns around, then maybe utilizing those funds to pay back the HELOC. And by not drawing into your investment accounts, you're avoiding maybe a tax implication, right?
Because that's the other issue. Most of these folks, you've got my classic folks. You've got a house and you paid off the mortgage, and you've got some tax deferreds. You've got a 401k that turned into an IRA. You've got some tax deferred. So one of the other advantages I tell people of doing the HELOC is that you're not having to pay income tax on those reserve funds at this point. You may want to kind of save those for later on. Once again, ideally, people say, yeah, but then what if I die? And I always say, well, that solves all the problems. Dying is not the problem. Living well until you die is the problem, right? Dying solves all issues, right? So can you just talk a little bit about, once again, they walked in the door and they're thinking about this. What's it going to cost them to do this? And is it related to the amount that they're borrowing? Because once again, when they're trying to compare apples and apples, they're looking at this versus a reverse mortgage, where I tell people the upfront costs are really, really high. So you need to really be
absolutely
comparing these, right?
Yeah, and for us, and really most lenders, there are no upfront fees for the home equity line of credit, unless you get into a much larger credit limit request or a higher LTV. Then there might be some costs associated, but it's marginal compared to, especially a reverse mortgage or doing a full first mortgage refinance.
So there isn't a kind of an expected automatic fee, like a point or a percent or 2%. I say.
Yeah, we majority of our HELOCs, there are no fees to take it out.
Right, and then I know that also I tend to be one of the biggest fees on this. The attorneys tend to be big fees when it's a first mortgage, right?
Right.
It's been my experience that that's much lower because a lot of that is handled internally when it's a HELOC or a second mortgage.
It is. We don't get full title insurance. We get a property rundown title report. Rarely do we have to get a full appraisal. It's typically just a automated valuation, very quick. Typically we close them in less than 30 days. It's really a very simple process for most applicants. Of course, you get into the larger requests or more complicated borrowers. It might be a little more to it, but really not much more. And
it's pretty straightforward.
Pretty straightforward.
So I really appreciate you doing, taking the time to do this. I think these are questions that folks come up with all the time. And we'll have a slide that we'll ask you to give us with your contact information,
Sure.
or the contact information for the bank, whoever they should be calling. But I just like you to leave people with, so if there are questions, what is the number? Who should they call? Who should they talk to? Right.
Yeah, they can reach out to me directly. And my phone number is 774-230-0945. Or if you go to our website, cornerstonebank.com, you can search for our lenders, and any of our mortgage loan officers, anybody in our branch can help you with this product. It's pretty simple, straightforward. Going to a local lender that live and works where you live, I think is beneficial. My suggestion is to shop around a little bit. Not all HELOCs are created equal. They're very similar in nature, but they can vary from fees, costs, interest rates. So it's important to really investigate those and check them out. And I think HELOC's a great product. I encourage everybody to have one, but they have to be used responsibly and carefully, because you don't want to use it as an ATM, so to speak. It is an emergency vehicle to help you out when needed.
And Scott, and I know you're referring to it as an emergency vehicle, but to me, it's a sleep well at night vehicle. It's the vehicle that you want to use before the emergency, right? So that you just know that if there's an emergency, you're not going through anything. You're just, writing a check. You just, and so I really appreciate you taking all this time, and I hope that if folks have got questions, folks, this is something you have to do. If you're Frank and Mary, if you want to stay at home, if you've got limited other savings, which is most people's situation, you need to make sure that your house is available. And I know you don't want to use the money because you want to leave it all to your kids. But what they're going to tell you is, Ma, look, and Dad, you saved that money. This is your money. Take care of yourself, right? And so this is an important tool for you. So thank you very much, Scott. I really appreciate it. And,
awesome.
and folks, I hope you tune into on our YouTube channel. You can find any number of these Bergeron briefs, as well as other seminars that we do on other facets of elder law. So thank you so much.
All right. Thank you, Arthur.